Welcome, everybody. I'm Erich Patten.
And I'm Brook Anderson.
And we're here to have a conversation today about the OBBBA, the One Big Beautiful Bill Act, and how it might impact you from a financial planning perspective. There is a lot in this bill, Brook.
There is, for sure.
So the bill, actually, it's over, I think, 700 pages. And there's a lot that includes financial planning topics as well as non-financial planning topics. We're going to talk about really some of the most pertinent issues that we think will affect our clients, and we're going to do it using case studies. First, let's jump right into it, Brook. What is actually in this bill from a financial planning topic? And you can see here, there's a list of topics that really are encompassed throughout the whole bill.
Yeah, there really is quite a broad number of categories of potential planning topics that are covered by the bill. We're not going to go into all of them. There's a lot of details that probably don't affect a lot of us. So we're really going to focus, as Erich said, on the ones that are probably going to hit most of us. But just know that there are some detailed things that your financial advisors here at Cutler could help you with if they are applicable to you.
Great. Well, let's jump right into it. We've got 4 case studies. You can see them here on your screen. There's 4 individuals. These are all made up people, but they represent really clients of Cutler, issues that clients of Cutler might come across. So let's begin with Jackie. Jackie is 47 years old. She's working full-time. She lives in Wasilla, Alaska. She makes $110,000 of income, and she wants to know, are my taxes going to go down this year? Will the OBBBA help her continue to support the American Red Cross? So, Brook, what do you think about that? Are Jackie's taxes going to go down?
Yeah, and that's a great point. I was going to say there's actually some cases where we don't always know exactly, but for almost everybody, most people, it will go down. And that has to do with the fact of the brackets themselves. The brackets, if you think back to the 2017 Tax Cut and Jobs Act, we took every single tax bracket down. And basically what's happening with the OBBBA is that those brackets are made permanent. So instead of a large increase, which is what would have happened had this bill not passed, they're going to remain low. So pretty much everybody's going to see lower brackets. Now there's some different situations that may cause differences amongst people, but the broad tax brackets are all coming down or will be lower than they would have otherwise.
Yeah, we're going to use OBBBA, OBBBA. There's a lot of different terms people are using out there. I think OBBBA is probably the easiest for us to say. Yeah. So we'll stick with that predominantly today. But getting back to our friend Jackie, some other financial planning questions that she might have. How does OBBBA, she's a non-itemizer, so she's using the standard deduction. How does OBBBA impact the standard deduction?
Yeah, so you may recall when the 2017 Tax Cut and Jobs Act was put in place, the standard deduction doubled, and that actually wiped out most people who otherwise would have itemized, now became standard deduction people. And this, the OBBBA maintains that position and actually slightly increases the standard deduction for a married person or a married couple is now going to be $31,500 indexed to inflation, and for singles, $15,750. And again, those are indexed to inflation, and those are again twice as high as they would have if OBBBA had not passed.
Yeah, one thing that was added to OBBBA as well is a charitable deduction for non-itemizers. And Jackie, as we mentioned, is a non-itemizer. She takes the standard deduction, but she likes to support the American Red Cross. And this new provision, it creates a charitable cash contribution deduction of $1,000 for single filers and $2,000 for married filing jointly. So she can take the standard deduction, have another $1,000 deduction on top of that. Really does help to keep her tax bill low.
Yeah. And I think there's one thing I'd like to add to that too. Just because they gave that $1,000 without any itemization for a single person and 2 for a married, there's actually a change in how the deductible portion works, and that is the first $1,000 for single or the $2,000 for married is not deductible because you already received that without a deduction at all. So it's not as though you're losing any ground with your deductions. It's just really how it's structured. So keep that in mind as well.
Absolutely. So let's move on to our next example here. It's Josh. Josh is 52 years old. He's a business owner. He owns an advertising business. He's married with 2 children in Palos Verdes, California, and he has $85,000 of income, and his spouse makes $67,000 for a total household income, if my math is correct, of $152,000. And he wants to know, how will OBBBA help him pay for college? He's got a couple of kids he's trying to save for college. One was just born recently, as a matter of fact. And he donates a little bit every year to his older child's school. Can he get a deduction for that as an itemizer?
Yeah, so the way that this works now is as somebody who itemizes and all of that, there are some opportunities as it relates to education. And a couple things I'll talk about specifically will be with regards to just starting with the child tax credit. And just so you know that now that's been made permanent, so now there's a little bit more money as you do have a younger person who would be in that student age. And it's been increased to $2,200 per child, and $1,400 that is actually refundable whether you itemize or not. So that's the benefit. Again, even if you don't itemize, it's still something that is refundable. And then as we kind of jump into the 529 savings, where a lot of us are familiar with that is actually broadened and increased for those who are before college, or let's say other related education that isn't college. It could be even as something as studying for the CPA exam, as an example. That is now deemed to be a 529 deductible, or
something you know a little bit about.
Yeah, exactly. Of course, they didn't have that back when I did it, but that's too bad. I guess at least those going forward will be able to benefit from that. And you can use those $529 to do that. And also that the amount that you could use for non-college education is actually doubled. It's now going to be up to $20,000, but it's not limited to just the tuition, which is what was the case prior. Now you can actually use it for your books, the computers, and everything else that's required to get through any type of qualified program. So that's a nice little benefit. And then lastly, I just touch on one other element that's really out there for students or for young people as they're entering into approaching the college years and everything else. That's the Trump accounts. There's been a lot of discussion around, are they worth it? Do they matter? And there is a case. And this is where I think you can involve your Cutler advisor to kind of give some guidance around this. But what these accounts are, I'll start with that, is that you can put into an account for a child what feels like an after-tax contribution to a traditional IRA. You might say, why would I want to do that? It's because they don't have earned income, can't contribute to it otherwise. But this allows contributions from birth till age through 17. And you can, as you contribute to it, it becomes an IRA. And you might say, well, I've always heard it's not a good thing to put in after-tax dollars to a traditional IRA. Normally that is true, but there's a unique aspect of this. You're talking about a child without income. And oftentimes they can even do Roth conversions with that money, maybe during the college years when they're not really earning a whole lot. What a great way to create a Roth account where they never qualify because they never had the income to do it. Now they can do it. And also, as a little kicker, for the next 4 years, any child born between, I think it's 2025 and 2028, will actually get a free $1,000 contribution to that account to encourage people to utilize it.
Yeah, I mentioned, thank you, Brooke. Josh is also a business owner, and there's a few things from a tax standpoint he can take advantage of as well from that perspective. First, married filing jointly, there's now no cap on the salt tax. So the state and local taxes, Josh is in a high tax state, assuming he bought his house recently in California. California, if you've owned your house for a while, your property taxes might be pretty low, but it's an expensive market, and home ownership is expensive there. Well, he can deduct that interest from his taxes. Businesses also have no SALT cap limitations. So
provided they're a pass-through entity, that's correct.
Yes. So provided it's a pass-through entity, if that business is paying quite a bit in state and local taxes, Josh can then deduct that from his business taxes. And then the other aspect from a business, he did mention he likes to give money to his kids' PTA. He can keep doing that either through personal capacity or through his business. If he does it through his business, though, if it doesn't meet a 1% threshold, he won't be able to deduct it. So he might be better off giving that money as an individual than actually having the business sponsor his kid's next school auction.
That's a great point. And one thing I wanted to comment on too is that on that SALT deduction, there are a number of provisions throughout OBBBA that have been earmarked for a particular period of time, and the SALT was one of those. And there was a compromise made when the bill was put together that it's only going to be for the next 4 years, and then after that it'll actually revert back to the 10,000 which we've been living under for since 2017.
And it's actually not unlimited, it's 40,000 on the upside. So
Yes,
up to 40,000, and it phases out. And there are many phase outs throughout a lot of these provisions in OBBBA. So,
Yeah, good point.
things that we say might actually, for higher income earners, they might begin to phase out. I believe the phase out for the SALT limit is around $500,000 of income. So if you're making more than that, you may not get the full deduction.
Yep.
Martin has 3.7 million liquid net worth. He also has a home that's worth almost $2 million, about $1.95 million. And he wants to know, will I be taxed on my Social Security? Chevy is 25. He works as a programmer. He lives in Beaverton, Oregon. He wants to buy his first home. How does OBBBA help our friend achieve those goals? What can he do from a planning perspective and really take advantage of some of these new tax benefits?